Welcome to the Corlin Economics Report, a weekly look at financial and political topics relating to asset-based investing. Guests on this program pay no fees to appear, and guests and hosts disclose any equity interest in companies profiled. Now, the Corlin Economics Report.
Hey everyone, welcome in to the weekend edition of the KE Report, a special Thanksgiving weekend edition. I hope all of our U.S. listeners are having a very great long weekend and enjoyed a great meal and some time off on Thursday, even stretching throughout into the weekend. We're happy to report that we do have a full show recorded for you, and we also recorded a number of daily editorials and company updates throughout the week on our website, kereport.com, and our podcast, The KE Report. On this weekend show, we're going to start off talking about resource stocks, more the metals stocks, and then in the back half of the show, switch over to the energy sector. We're starting off the show with Adrian Day, founder of Adrian Day Asset Management, also manages the Euro-Pacific Gold Fund. Now, Adrian, as I said, I want to stick to the stocks, and I want to start off with the precious metals stocks, the higher end of them, the majors, because we have gotten through earnings season. I want your take on how the majors are doing from an earnings perspective. What stood out to you? What surprised you? Please break down some of the majors, their earnings.
Yeah, as always with the larger companies, it's always a bit of a mixed bag. You know, if a company has a dozen mines around the world, there's always going to be some that have upside surprises and some that have downside surprises. That is not surprising that there were some good and some bad. I would say, generally speaking, that at most companies, operations are doing reasonably well. Cost increases are beginning to moderate a little bit. What was perhaps a bit surprising is that most of the companies, probably most of the companies, are still going to be right at the lower end of their earnings estimates for the year, their earnings guidance for the year, or even miss it for the year. So Barrick is going to miss in all likelihood, and costs for Barrick are going to be above their guidance. Royal Gold is going to be right at the low end or perhaps miss. And I think that goes to the over-optimism that we had at the end of last year, beginning of this year, when these annual guidances were set. And again, there's always something that goes wrong. And we can look at Royal Gold. They had more than 2 weeks. Sorry, it was more like 2 months suspension of mining at Penasquito, which is one of their larger royalties, not their largest, but one of their larger royalties. Well, obviously, that affects your earnings significantly. It also affected Wheaton, which also has a stream on Penasquito. Royal also has a fairly significant royalty on Pueblo Viejo in Dominican Republic, which is Barrick's mine, or Barrick and Newmont's mine. And the ramp up to the expansion of Pueblo Viejo is going much, much slower than expected. And whereas they were expecting it to be sort of up to speed by the third quarter, it now looks like it's not going to be until the middle of next year. And so that hurt them. And then also Centaurus at Mount Milligan, which is their largest royalty / stream, they also came out with reduced production guidance. So again, for a company like Royal, which is a royalty streaming company, all of these operational issues are outside of their control. But it just shows, I guess it goes to show that when they're setting guidance at the beginning of the year, you're not thinking you're going to have a suspension at one of your mines. You're thinking that the ramp up is going to go as planned and expected by the operator, Barrick, and so on. And so, it hurts the earnings. But yeah, so those are a couple of things that did hit me. But I think it's also worth noting that there are, multiple companies that seem to have turned the corner on operations. And one I'd point to would be Fortuna, which is not obviously one of the largest, but, if you go down a step to the intermediate, they've had 2 or 3 years now of just of let's say bad things happening. The market didn't like it when they expanded from Latin America to West Africa and punished them for that. A lot of people didn't like it when they expanded from silver into gold, although they already were producing a lot of gold. Let's not forget that, but that hurt them. They had a bunch of misses, frankly, on their quarterly reports, and they also had that horrible fiasco in Mexico with the San Jose mine, where the environmental agency, we don't need to rehash that, but people who know it will know what I'm talking about, and people who don't just take it that it was an 18-month fiasco where the environmental agency tried to cancel their long-term mining permit, in effect. What we've seen with Fortuna in the last 3 quarters really is increasingly they're, hitting their stride. The production and the earnings and the costs are where they said they would be. And this last quarter for Fortuna was really quite a stunning quarter, led by the first quarter at Séguéla, which is the new mine in Ivory Coast, with very, very low costs. I think their costs for the quarter were under 600, and that brings down the costs across the whole company. The federal court in Mexico has upheld their 12-year mining permit, which is what the permits in Mexico are, the longest they would be. They just renewed, and they renewed for 12 more years. And so we had good operations, good production, and very low costs. So that's a company in my mind that is perhaps set for a re-rating. But I think, the thing to remember is that anytime you have a large mining company, you're always going to have some, if not every quarter, but you're always at risk of having 1 or 2 major things go wrong at 1 or 2 of your operations. And I think the market this year was not really prepared for that.
Yeah, Adrian, there's no shortage of problems that can befall the mining industry, but to the point you made about a lot of the intermediates and mid-tiers turning their ship around and things starting to improve and inflation starting to moderate, there's still pretty healthy margins, and the majors have been tied up with each other, really acquiring one another for the last couple of years, and a lot of people keep asking us about M&A. When are we going to see more M&A in the sector? We have seen a little bit of that, a couple of the mid-tiers like B2 Gold going down and grabbing Sabina, or more recently, Calibre grabbing Marathon Gold. Do you think we'll continue to see that trend out of the intermediate producers where they have improved their operations, they do still have good margins at these prices, and maybe they'll go on the hunt for some of the junior development companies or single asset producers?
Yeah, I think we're going to see more of that. And what we haven't seen much of is the seniors buy the intermediates at big premiums. We haven't seen that. But I do think we're going to see more of the better quality, more well-financed intermediates like B2 and Fortuna, frankly. I mean, again, both of those 2 companies have had some acquisitions in the last couple of years, but both of those are in a strong enough position where they could take on something else. I think we're going to see more of that, frankly. I never really buy something because I think it's going to get taken over, because you just never really know, because there's so many factors that go into it. A company could be ripe for being taken over, but the obvious candidates for buying them just have other things on their plate at the time. And so these mergers and acquisitions don't always happen when we think they should. They often take a lot longer to happen. But yeah, there's no question in my mind that we're going to see more of the intermediates get together to build larger companies, and the intermediates buying the single asset developers and even producers. I think we're going to see more of that.
Now, do you think it matters if it is a developer or a producer? Because it seems like right now, if you have a mine that's up and running, that carries a lot more weight than these developers that still need to build these mines because of higher costs that have come in.
Well, that's an interesting point, because a lot, depends. There's 2 ways of looking at this. If a project has just got a feasibility study, I think most larger companies would prefer to buy that before they start doing the financing and doing the construction. Because company A, that is, let's say company A that's a larger company, they want to decide where the financing comes from. They want to decide if there's any hedging or any forward sales that go along with that. They want to decide if there's a stream on the asset. And they might want to decide, albeit there's a feasibility study, but they don't want the construction to start and go too far down the line, which locks them into a particular mining scheme. And so I think if you've got an asset that has not yet started to be constructed or the financing isn't there yet, a company would prefer, and you saw that with B2, a company would rather go in and grab it before a lot of that stuff is set in stone. You know, if you're in a more, let's say, a more risky, I think most companies certainly want the junior to have the permits in place, because in many jurisdictions, you know, it's a lot easier if you're looking at, you know, whatever, call it Ajax if you want. But if Ajax has been working in the remote part of Peru for the last 10 years and built a good relationship with locals, you want that smaller company with the good relationship to go ahead and get the permits before, you know, the big beast from the United States or Canada comes down, which means they have to start the whole process of community relations again. So, yeah, I think you definitely want to get the permits, but I think most of the companies would rather not have the financing already underway. Because again, as I mentioned, you know, a company A may decide, you know, in their financing package, they'll issue X amount of shares, but they'll put a stream on it. And a larger company may not want the stream. So they want to get in before that happens.
Well, Adrian, just speaking of the streams, we were at several conventions and conferences this year where the development stage companies, or even big producers that want to build a development project, are in a bit of a pickle to raise capital. You know, sometimes the capital markets are more expensive now because of higher rates. They don't want to dilute shareholders down with equity raises. And so they're looking at the royalty and streaming portion of the business to fund part of the CapEx build. And especially when you dive down into the development companies, they're so undervalued right now and their cost of capital is not nearly as attractive. They've got to raise huge amounts of money to get a mine built. What is your position on them putting a stream or royalty on the project? Does that dissuade the majors or the larger companies from buying them eventually? Is it a good solution? Is it good for the royalty companies right now to be going after that part of the business? What's your take on that discussion?
Yeah, no, absolutely. Well, look, first of all, if you're a development company, if you're a company with a project and you want to build that project, there's a lot of people out there, and we know who they are, but there's a lot of people in the industry who say royalties and streams are bad for the business and I'm never going to do that. But the truth is, if you've got an asset that you want to build, you have to dilute it some way or the other. You either bring in a partner, which means you dilute at the asset level. You borrow money, which has to be repaid, which is part of the cash flow from the mine goes to repay your loan. And the loans always come with some sort of terms and conditions. You have to issue equity or you issue a stream or royalty, but you have to dilute in some way or another. And as you alluded to there, it's really a matter of looking at the market at any given point and saying, where can I get the most money to build my mine for the least dilution? And right now, you've got very, very low stock prices, as you said. So issuing equity is very expensive. You've got high interest rates. And a lot of US banks are not lending to mining. Some of the Canadian banks still are, and some of the European development banks still are. But, you know, it can be difficult for a larger mine to get significant debt financing without onerous covenants on the debt, which you don't want. And so sometimes right now, streaming can in fact be the most favorable form of financing. It varies with the market, but I don't think one can be a purist, if you like, and adamant and say, you know, I don't want to do a royalty or stream because that gives too much away from my future mine cash flow. Because you're always going to have to dilute. So right now, given the market we just talked about, streams become much more attractive to a development company. Because royalty streaming companies, as we know, they go through phases, looking for different areas where they can come in and provide something to the company at a good opportunity. So, 8-10 years ago, of course, we had the big blow-ups and the big diversified base metal companies. And so the royalty companies were able to come and write large checks for balance sheet repair and get significant byproduct royalties or streams that would last a long period of time. Well, that period has gone. And for the last several years, companies were sort of, in 2016, 17, 18, companies were saying, well, the royalty companies, where can we now find attractive opportunities? And right now, the attractive opportunities are with largely single asset developers who need money to build their mine, can't get it from the banks or can't get sufficient from the banks, don't want to raise the equity, and don't particularly want to bring a partner in. And so the streams are an ideal financing in this environment, which is good for both parties, in my view.
It is, but it is also sometimes handcuffing to some of these companies that, quite frankly, just don't have a whole lot of financing options right now. The royalty and streaming companies, they are liking this environment because they do have money. Let's shift our focus a little bit more to another sector that we touched on the last time we had you back on the show, and that's critical minerals. Can you share with us your approach when investing or even looking at investing in any critical minerals or the companies?
Sure. I mean, if we're including the big metals like copper in critical metals, I think copper would be after gold and silver would be my number one favorite. And we see increasingly in the news in the last 6 months how the copper supply is challenging. And it's not just challenging 5 years out, it's becoming challenging right now. We saw that with Codelco in their recent report. The CEO left after less than a year, and he pointed out the difficulty of building large copper mines in his country, in Chile, and likely ongoing reduction in production from Chile. Again, he was the CEO of Codelco, so he was focused on Chile. But we're seeing that in a lot of countries. So to me, copper is very, very, very compelling, and the valuations of the stocks, notwithstanding the little bounces we've had recently, but the valuations of the companies are very, very compelling. In copper, I'm really looking at two main areas. One would be, the very largest and the best. So, I mean, if an ordinary investor wants exposure to copper and doesn't want to be, looking at exploration companies, dealing with the risk in exploration and looking at the companies day in, day out, it's difficult to go wrong with Freeport, which is the largest of the publicly traded copper companies. But we're going to see more consolidation among the larger and second tier copper companies. We've seen Teck agree to sell their coal business so they can focus more on the copper, become a more pure copper company. And I think whether you're looking at Antofagasta or Teck or First Quantum, I think we're going to see some M&A in that sector for sure. And of course, the reason Newmont bought Newcrest, it wasn't for their gold mine in Papua New Guinea, it was for their copper primarily. When we go down the list to the sort of smaller critical minerals and what used to be called strategic metals and rare earths and all that kind of stuff, I must say, this is the way I do it. It's the way I feel comfortable doing it. I prefer not to sort of jump on these bandwagons, which have been very, very successful for a lot of people. Don't misunderstand me. but I prefer to get exposure to these smaller metals and more specialized minerals through other companies that I like anyway. So as an example, Midland Exploration, which is exploring for gold and copper in Quebec. They also have a big push on with 2 joint ventures looking for lithium. One is with Rio Tinto. If they are successful, that will be a meaningful boost to Midland. If they are unsuccessful, it doesn't destroy the company because it's not a pure lithium play. And so whether it's Midland or whether it's Kenneland, which also has some lithium, whether it's Altius, which was a large shareholder, still is a large shareholder in Lithium One that they spun off, and they retain some shares and some royalties. I'm getting exposure by investing in those companies. You're getting exposure, meaningful exposure to the smaller metals, but without the risk of the pure plays.
Are you picking up on the trend that a lot of the interest in critical minerals is coming from investors not traditionally in gold and silver stocks or the precious metals, maybe not even interested in copper, but they're coming in through the doorway of lithium and EVs or rare earths or graphite, manganese, some of these smaller metals, as you say, more niche metals. But you are seeing the governments of the world put money into these projects, especially nickel and lithium and rare earths. You are seeing manufacturers like battery companies, automakers, coming down and partnering directly with lithium companies, nickel companies. Do you think that's a new dynamic the resource space hasn't seen before? And what do you make of that groundswell starting in the critical minerals from the government and manufacturing side?
Oh, it's absolutely a new thing because gold mining companies traditionally have sort of been their own little sector. And, governments have not, certainly for 50 years, governments have not been at all interested in the gold mining sector. And certainly large traditionalists, whether they're investors or whether they're, companies, as you mentioned, have had no reason particularly to look at the gold mining sector. But now you're seeing interesting developments, as you mentioned some of them. But I mean, one interesting development that may go nowhere, but one of the large U.S. car manufacturers approached Agnico, and this is public, approached Agnico to see if Agnico wanted to sort of be their arm for looking for lithium in Canada. And the car manufacturer was willing to put up 100% of the costs of that in return for the supply. And Agnico would get, their proportionate compensation. And what's interesting is Agnico has no expertise in lithium. Agnico has no history in lithium. And yet, one of the car manufacturers, and we don't know which one it was, at least I don't, it hasn't been publicly announced, looked at Agnico and saw this is a very successful gold mining company that knows Quebec and Ontario and Nunavut. They know the area. They're good. They're quality. Hey, let's joint venture with these people. So I find that very, very interesting. And again, Rio is jumping all over smaller companies in Canada looking for lithium. So yeah, we're going to see more of that. No question. And how much of this will develop into actually producing money-making mines, that's another question. I don't want to be the cynic, but, I've been around a little longer than you two, probably longer than you two put together. I remember we've been through these booms in the past. There was a nickel boom in Australia in the 70s, and there was the rare earths boom in the 80s, and there was a strategic metals boom in the 90s. And each one of these, rode very, very strong and collapsed at the end. And, sometimes there wasn't an awful lot of actual production to show for it. I'm not saying that's going to happen now because obviously the electrification is a very, of both the power grid and automobiles, is a trend that's going to stick around for a meaningful period of time. But that doesn't mean that everyone looking for lithium is going to find lithium. And more importantly, what they find isn't necessarily going to become a profitable mine. I'm also concerned, frankly, with some of the niche metals, and this is a longer term concern, but of substitution. I don't think copper's going to be substituted for anytime soon. But as you know, people are working on batteries of various types that don't need lithium, and so substitution is always an issue. And it's not so much for cost, because as you know, when you have a critical element in a battery or in a uranium in a power plant, the cost is almost insignificant. You need that critical element. The company's going to pay whatever is required. But there'll always be substitution when people work on not so much cheaper versions, but on better versions, on versions that don't require metals or minerals that are in short supply. And so, that's always something that's going to happen. And it may take 10 years or 20 years, but we're going to see that happen, no question. I mean, just as 50 years ago, we didn't have lithium batteries. And so these things do change and develop over time.
All right, Adrian, thank you very much for your time. Diving a little bit more into the stocks. I always enjoy reading over your work and following up with you, getting your thoughts on these markets, also diving into the critical minerals. Adrian, thank you again for your time this weekend. I hope you have a great long weekend. I'm sure we'll chat again next month. Everyone, stick around. We're going to be right back, shifting our focus to the energy sector.
Thank you so much.
Al Corlin's firm, A.B. Corlin and Associates Incorporated, provides consulting services to public companies on matters of regulatory compliance. To find out more, follow the link from www.kereport.com. The Corlin Economics Report will be back after this brief timeout. Providing unique reporting on markets and companies since 1990. This is the Corlin Economics Report.
All right, welcome back. Continuing to listen to the weekend edition of the KE Report. And as promised, we are moving our attention over to the energy sector, more specifically oil and natural gas, as we are chatting with Josef Schachter, founder and editor of the Schachter Energy Report, also writes the free report of Eye on Energy, where Josef details the fundamentals of the oil and natural gas market. That's where we are going to start. It's where we usually start because there are some key aspects to talk about, especially in the oil market fundamentals. When we look at price, though, Josef, boy, oh boy, oil was up above 90 at the tail end of September and has gone almost straight down outside of a little bump halfway through October, now trading in the, let's say, mid-70s. But I don't know, there seems to be quite the downtrend here for oil. Let's talk about some of the fundamentals. What, in your eyes here, Josef, has driven the oil price so much lower from those above 90 levels?
Sure, it's my pleasure to be with you again. Let's talk first about the demand side. On the demand side, the two countries that matter, of course, are United States and China. And the U.S. demand is down year-to-date versus last year by 0.6% to 20.19 million from 20.31. So there's no growth in U.S. consumption. We know China is sluggish and it's negative, and imports are down. So if the two biggest countries are not importing more oil or using more oil, in the case of the U.S., they fully meet their needs because they produce 13.2 million barrels of crude oil and 8.9 million of NGLs and renewables. So they're fully self-sufficient against their 20 million of demand, and that's why they're exporting. And what they're exporting is the lighter crudes that come out of the Permian, because the refineries on the Gulf Coast are built to handle heavy oil. And so they take in heavy oil from Venezuela, from Canada, and they use that to create the products there. at those elaborate refineries on the Gulf Coast, and then they ship and export out of the lighter crudes. And last week, exports were 4.8 million barrels, which was mainly the Permian, Eagle Ford, lighter crude oils. So then let's go to the production side, and the positive is the rhetoric from OPEC that they've cut back by 2.2 million barrels, 1.2 million barrels from OPEC as a whole, 1 million extra from Saudi Arabia. But then the old comment, did you have trust but verify? They talked about from military side, you got to do it also on the economic side. And the data doesn't support the commentary that the rhetoric, the topical barrels versus real barrels. In June of 2023, before the cut started in July, OPEC was producing 28.2 million barrels. And in October, the last data point came out 2 weeks ago, 27.9. So they've only cut back 289,000 barrels versus the 2.2 that they've talked about. And the little bump you saw in the last few days before today's collapse was that they would probably extend the cuts from the end of this year to the end of Q1 or even Q2. And then there were some of the bulls running around saying, oh, they're going to cut another 500,000 by 1 million, OPEC as a whole. That this morning was thrown out of the way because countries like Nigeria and Iran, Angola, and others said, no, we're increasing production. UAE jumped in there as well. So all of a sudden, the price of crude went below $74. I think 73.70 or so was the low. And then Saudi Arabia came back and said, look, if you guys aren't going to play ball, we're only producing 9 million barrels. We can produce 10, 11, or 12. If you guys don't come along, and next Thursday is the meeting, then we could increase our production, and all of a sudden the price of oil would be in the 60s. And so there's the market said, oh, that's good news, because the other guys aren't going to want to see the price of oil break 70. So there's a little optimism later in the day. But my view simply is that between now and Thursday, next Thursday, there's going to be a lot of gyrations in the market. And in the end, I think the countries that need the money have high populations, Nigeria, Iran, Venezuela, and they're desperate for revenues. And then the bottom line is Saudi Arabia is not going to be able to rein them in. And then Saudi Arabia threatens to increase but doesn't increase. Just the threat, I think, will bring prices down below $70 WTI. If you remember, when the last time we talked, I thought we would go down to 74 to 76 when we were in the high 80s. Now I think it's possible. I'm using an official target of 70 to 73. But if Saudi Arabia does use the nuclear option, i.e. Open the taps, then we go back into the 60s. And I don't think we go down to 64, which we did in March of 2023. That would be below production costs in many countries.
Yeah, Joseph, it's really an interesting tightrope a lot of these countries are walking with Saudi Arabia and the OPEC Plus members because they need the money, they need the production, they want to up their production, and they clearly have been because they have not cut those 2.2 million and cuts, as you mentioned. They only cut about a tenth of that. But if the price goes too low, then some of them are not profitable anymore. So it is a fine line to walk. But you made the point to us off mic that there's other growth areas outside of Saudi Arabia and the OPEC countries next year, including some of the growth that we see in Guyana, Brazil. Even Iran's going to keep trying to produce more to fund some of the activities they have going on globally. And then there's also production increases coming from U.S. companies like Chevron. So maybe walk through, on top of all this, there's pressure from just more production in general coming into next year.
If you remember, Guyana's become a really big, successful offshore discovery area. Hess is being bought out by Exxon. Exxon's there. You've got other companies that have been from Europe that have been successful. And in 2024, Exxon and Hess are bringing on 400,000 barrels a day. So there's, those are barrels that are coming on. And then you also have offshore Brazil where salt domes, there's been some big discoveries. But again, it takes many years to bring them on, but they're bringing them on 250, 350,000 barrels a day coming on there. And then Venezuela, Chevron alone was producing nothing, a year ago. Now they're 135,000 barrels a day being brought into the U.S. Gulf Coast with authorization by President Biden. and they just got authorization by the Biden administration to sell diluent to Venezuela. And just like you need diluent in Canada to move our heavy barrels, be it our oil sands barrels or our SAGD barrels or our conventional heavy barrels, Venezuela needs diluent. So they've been given the authorization, Chevron, by the Biden administration to trade diluent for heavy barrels, and that's going to increase Venezuela's production as well. So we're looking at potentially a million quarter barrels of new production coming in non-OPEC, and so I don't think demand in the first half of 2024 is going to be more than that. So that kind of boxes OPEC in, and then in the second half, I think there'll be demand growth, and the question is, by then TMX will be on, and then what does Iran produce? What does Venezuela produce? Incrementally, I think OPEC's market share is going to come down, which means that some of the OPEC members who are desperate for money, they say, look, even though the price has gone down, I can sell more barrels, and they can look at the trade-off and just decide, look, we need the money, period. And Saudi Arabia doesn't. They're rich fat cats. They don't need the money.
So, Joseph, looking into next year, do you think the oil price is going to go up or is it going to fall? It seems like demand might stay somewhat restrained, but supply might even pick up.
Yes, I think in the first half of 2024, we're probably range-bound between high 60s and low 80s. But in the second half of 24, I think you're going to see demand growth in India. China's going to be back on track. The Chinese government will find some way to get that economy moving again. And I think the third world countries, where we want them to bring on more copper, nickel, lithium, cobalt, they're going to be seeing demand growth. And that will probably bring the price of crude oil back over 90. And if there's any disruption of a waterway, any disruption on the military side, any Iranian attack on shipping in the in the Red Sea, Strait of Hormuz area, we could see spikes for short periods of time over 100. So I think this next decline, which would be market related, demand supply related, takes us down into December, maybe January at the latest. And that's going to be a fabulous buying opportunity for these stocks. Many of them are down 20, 30% from where they were in August. I think there's another 10, 20% decline coming, but that's going to be what I would say is a great buying opportunity. And we're going to be sending out action buy alerts to our subscribers, our paid subscribers, giving them some great new buy recommendations, both on the natural gas side, the oil side, the energy service sector, both domestically and internationally. So I think there's going to be some great buying opportunities. We've, talked in the last number of times that we talked, people should hold cash. If you got dividend income, hold the dividend income and just wait for the next great buying opportunity. It's imminent now.
Well, Joseph, just along that same point, you have made the point in your written piece, the Ion Energy, that you're really tracking the oil producers' bullish percentage index, and you've noted in the past how quickly that can devolve, how quickly that can actually sell down as far as the sentiment towards these companies, as far as how they're doing, and you're watching some key levels in that. Just break down for people not familiar that the bullish percentage index, how you're using that as a tool to factor in on the good buying opportunities.
Yeah, historically, this is an index in the United States. It's called the S&P Energy Sector Bullish Percentage Index. Historically, every time it gets over 90%, stocks are overbought and overheated and overvalued. And anytime it gets below 10%, it's a buy signal. And every once in a while, not very often, the last one was March of 2020, so, during COVID, does it get below 5%, which I consider a table-pounding buying opportunity, and that was the last time we had one of those. So just to give you an example, in March of 2023, when we turned bullish and we added quite a few names to our buy list on March 13th and March 15th, the index went from 43 to 8.7% in 1 week. If you go back to the last little while, we were at 96% in early September, and then it came down to 48%. It rallied to 74% at the beginning of November, and just in the last couple of weeks of November, it's dropped to 43%. So my thinking is that if we see the price of oil go down because of Saudi Arabia and OPEC not getting their act together to support pricing, that it will come down below that 10%. And once that does, we will add a lot of new names to our buy list, and we will go fully into the bull camp, not the hesitant bull camp that we are now.
So that's a pretty big fall still from where the bullish percentage index is. How much lower could these stocks go then? Are we talking a further 20+% sell-off in the stocks?
I think that, 10-20% is, the average right now is 255 on the S&P TSX Energy Index. And I think it's going below 230, maybe even as low as 220. The low for the year in March was at 209. So I think there's another 10% in the average. But remember, the average has CNQ and Suncor and other big names in it. So they may not drop, the full 10%. But some of the higher beta, some of the names that are heavier barrels, some of the names that have more debt problems, they may go down more than others. So I'm looking for some great buying opportunities coming up. A lot of the stocks, we in our reports to our clients put out a recommended buy level, and many of the stocks we cover just in the last few days, of downside have come into those buy ranges. So I think we're going to have a lot of choices to add once we get down below 10%. Like, there's three triggers that I have right now that I'm watching. Number one is the price of crude oil. So I think it's going down, as I mentioned, a month or two ago, each of those times, 74 to 76. My revised downside is 70 to 73. We were, so one more downtick. If Saudi Arabia doesn't get OPEC's act together next week, we could get down there. The second one that I'm looking at is the S&P TSX Energy Index, which I said was 255, getting below 230. So that's a 10% decline. And the third one is the S&P Energy Bullish Percentage Index, which was 43% yesterday. That number will come down today because it's adjusted at the end of the market close, given how weak stock prices in energy are today. And I think that's going to get down below 10%, and that will give me, three different views of bargains. All I need is one of them to trigger adding more names. I think it's very likely that two or even three of those indicators will all click in around the same time, which is the most confidence you can get when you say buy, buy, buy.
Yeah, Joseph. So you're going to be watching those three trigger points. Even if two of them hit, it's good for contrarians to start positioning into the weakness. But if three hit, then you definitely got a buy, buy, buy zone. So in that kind of a scenario, would you be interested in buying quality on sale, or would you be more interested in buying some of those most beat up ones that maybe don't have as good of margins, that maybe are more at risk and have been punished more? Because a lot of times after a big sell down, it's the most beat up stocks, maybe the less good stocks, that actually perform better on the upside. How would you play it?
I think it depends upon the individual investor's risk tolerance. A lot of the clients we have are older, conservative. They want dividend yields. So they're looking at the higher quality names with like a White Cap on the oils, or a Paramount Tourmaline on the natural gas side, which provide dividend yields which are regular plus special that are very, very decent. Peyto, another one, Birchcliff, another one. And so on the natural gas side. So to me, those would be the bigger cap names that people will want. And then you look at the utilities, Enbridge, TC Energy, they're yielding, 8% kind of numbers. So people who want conservative, a total return where you might get, the 8% plus a, 10% capital gain, there's some great opportunities I see coming there. And then for people looking for more entrepreneurial names where there's exploration upside and volumetric increases, because most companies in the patch are flat to slightly up at best, 2, 3, 4% in volume growth. There are companies out there that are having decent upside in their volumes between the beginning of 2023 and the end of 2023, with guidance that by the end of 24 they'll even be higher. Those are the names that would have the highest capital gain potential, and we're looking at names in all three categories to recommend to clients. And then depending upon the individual's risk profile, risk tolerance, yield requirement, age, and sophistication, involving in terms of keeping up with the stocks, everyone has to make the decision accordingly with their investment advisor to see what fits their portfolio requirements.
So, Joseph, are there any stocks out there that offer outsized yields right now that you have seen? I've seen a lot of companies, they do keep issuing special dividends. They do try to raise their base dividend. But any stocks that catch your eye that you say, man, this yield is astronomically high?
I'll have to be a candid or full disclosure. I own some of those. And, Birchcliff is yielding 11%, which, and Pado is yielding over 10%. You've got some unbelievable yields out there. Hemisphere is yielding 8%. You've got Whitecap Resources yielding almost 8%. So there's some fabulous opportunities out there for individual investors right now, but I think they'll even get better if I'm right about the market taking these stocks down a little bit more. And again, if the price of oil goes down, then, a Whitecap, a Crescent Point, they're going to go lower. But there's lots of upside when we turn. Pine Cliff yields 8.6 is a natural gas story. In Play, which I like, as an oily story, their 7.3 yield. That could become a 7.5, even an 8% yield on this market decline. So I think people should be doing their homework on the different names. That's what we provide in our research product. And people can go to www.schachterenergyreport.ca and they can see, the kind of things. We have some complimentary older copies of our research. And then, if they decide they want somebody to provide them independent input on the names they're interested in, then they can, become subscribers. And then if they want to meet management face-to-face, come to our conference like you did this year.
Well, you brought up an interesting point there with companies like Birchcliff and Pinecliff that they have some nat gas exposure. And that brings up the debate of, are you more interested in nat gas stocks or oily stocks? I know you had a mix in there because you had In-Play and Hemisphere that had the oil. But between the two, if you were more bullish on one than the other, are you more bullish on nat gas moving into next year, or are you more bullish on oil?
I'm more bullish on nat gas, and that kind of disagrees with some of the pundits on BNN. The reason I am is that the growth in oil between now and the end of 2024 might be 1 million barrels on a 102 million barrel increase. If you go into the end of the decade, it might be 2 or 3 million barrels, so from 102 to 104, 105. So you 2-3% growth. If you look at the natural gas side, the LNG side, the LNG, is right now exporting, and I'll have this, and I'll be discussing this on our webinar tomorrow night, is about 16 BCF. That's going to double into the end of the decade. And of that, 4 BCF or 5 BCF will come from Canada. We have no exports now. LNG Canada comes on in late 24, early 25. But then you've got cedars, you've got wood fiber, you got a number of them coming on before the end of the decade as they go through FID and all the final government approvals. And so if you look at production in Western Canada, about 16, 17 BCF, you add 4 to 5 BCF on that, that's a big percentage increase. So my view is we're looking at a better upside in price and in profitability of natural gas into the end of the decade versus oil, which is also going to be positive, but not as positive. So my number one picks are natural gas stories, and for those who are SCR subscribers, they can see on the SCR ownership page, which discloses mine and my wife's holdings, we're focused more on natural gas.
All right, Joseph, thank you very much for taking us through a lot more coverage on some of the stocks as well, what you like, and especially what you like into next year, because sounds like it still might be a tougher environment for the underlying energy prices through the rest of this year. But hey, you're bullish in 2024. It's something we will definitely be following up with you on. Joseph, thank you for your time on this special Thanksgiving edition of the Weekend Show. Everybody, thanks for taking time out of your long weekend to join us. As always, go back through our website and podcast. Check out all the daily editorials and company updates that we recorded throughout the week. We'll be back with you next week. I hope you all have a great rest of your weekend.